Good morning. This is Larry McMillan with a market comment recorded before the market opens on Monday, March 23rd. Well, things certainly didn't get any better last week, although hopefully we are oversold enough for some sort of pain relief rally. The S&P did put in a bottom. It broke through that 2350 support, but found some support at 2280. I'm really kind of reluctant to use the word support because nothing has really supported anything so far. But it did bottom there and bounced. It bounced quite a bit, but then kind of started to retrace. Last night it got almost back down to those same levels again, but now has reversed upwards. We were down the limit in the futures, and now we're back on the plus side this morning. The chart of the S&P is a total bearish chart. I mean, there's a room for an oversold rally all the way up to the 20-day moving average, which is falling rapidly, but it's still 300 points above current levels on the S&P. So that would be a substantial rally. Even a couple of hundred points would be. We move so fast nowadays, though, that that time frame could be very condensed. Meanwhile, the put-call ratios continue to climb. They're at levels we haven't seen in a long time, since 2008. And that includes not only the equity-only put-call ratio, but the total put-call ratio and the CBOE's equity put-call ratio. So those are all racing higher. When they roll over and peak, that will be a buy signal, but it hasn't happened yet. Typically, going off the way that these things behave, it probably still could be a couple of weeks before those things roll over. Market breadth, of course, has been poor, and our breadth oscillators are very oversold but remain on sell signals. So again, it's going to take several days of positive market breadth to reverse that condition into a buy signal. That's unlikely to happen. We haven't even had 2 days of positive breadth back to back in a while. In fact, I believe they said there hadn't been 2 positive days in the S&P back to back, and that's not just breadth but price, all the way into early February, so even before the top. New highs are basically non-existent. New lows dominating everything right now, so that indicator remains negative too. Volatility did come in a little bit at the end of last week. VIX declined some, and so a VIX spike peak buy signal is in effect. That has, well, not been the best signal recently, but it has a great track record going way back. So that is the one positive confirmed buy signal that we have right now. It's a fairly short-term, 1-month sort of thing. Would not normally indicate a turning point in a major bearish market like this, but it's something. The trend in volatility is still higher, as the 20-day moving average is well above the 200-day, so that's negative. The term structure of the volatility derivatives is also negative. There was a little improvement on that front last week, but basically still the front month April VIX futures are trading about 7 points higher than the May. So that's a huge inversion, and that remains a bearish factor over the entire market as well. So it's likely that we'll get some oversold attempts again on to bounce. To get actual intermediate term buy signals, though, it doesn't look like any of those are going to be setting up soon. I will say that an oversold rally, as I mentioned before, can climb all the way to the 20-day moving average, which is falling rapidly, and then fail. That climb up to the 20-day often looks like it's very attractive and things are okay. But then you come back down and test the low. If it holds, then you have the powerful W bottom formation for a market. But if it fails, then you have another problem at hand. Just a couple other little points. I've been doing a study on volatility. This is now officially the 4th most volatile market on record, perhaps the 3rd, depending how you measure it, with 1931 to 1933 being the most volatile, and especially the crash of 29. Throw that in there too. Then 1987 crash, and then the 2008 financial crisis. So we're right up there with those boys. That's not really a good thing. but we'll work our way through it as we see it. At this point in time, we've taken off a lot of our bearish positions because they're not really setting up anymore. But bullish positions are hard to justify without confirmed buy signals from the indicators. Please visit our website, optionstrategist.com, for information on our subscription services, which have been doing very well in this market and generally do pretty well overall anyways. And also, this Saturday, we moved our Saturday webinar from the 21st to the 28th. It was just too crazy last week. We're doing other webinars as well. So we have a webinar coming up Saturday where we'll discuss the market, we'll take questions, and then we'll have a webinar on option basics. So thanks for listening, and see you next week.